The National Bureau of Economic Research defines a recession as a significant decline in activity spread across the economy, lasting more than a few months, visible in industrial production, employment, real income, and wholesale retail trade. Economic recessions can be triggered by a number of events in the economy, such as supply chain disruptions, financial crises, or global events. Recessions can also be triggered by inflation. As inflation rises, the likelihood of a recession also increases, leading to layoffs, job losses, and higher interest rates. Businesses and consumers are increasingly worried about the economy, holding on to their cash and cutting back on spending. During a recession, businesses are forced to reallocate resources, cut production, limit losses, and lay off employees. Recessionary trends include rising unemployment and 2 consecutive quarters of declining GDP. Disclaimer: anything mentioned in this video is not financial advice, and you should do your own research before making a financial decision. First off, what are the signs of a recession? The standard macroeconomic definition of a recession is 2 consecutive quarters of negative GDP growth. When this happens, the private sector often tries to cut production and limit its exposure to systemic risks. Measurable levels of spending and investment may fall. There may be natural downward pressure on prices due to weak aggregate demand, GDP declines, and unemployment rises as firms lay off workers to reduce spending. At the microeconomic level, firms will experience profit margin decline during recessions. When revenue from sales and investments decline, firms try to cut the most inefficient activities. For example, they stop producing low-margin products or cut employee compensation. They may also negotiate with creditors and seek temporary interest rate reductions. Unfortunately, declining profit margins can force companies to lay off less productive employees. So, what causes a recession? The main economic theories of recessions focus on the financial, psychological, and underlying economic factors that lead to the chain of business failures that constitutes a recession. Some theories focus on the long-term economic trends leading up to a recession, while others focus only on the visible factors that appear at the beginning of a recession. Others focus only on directly visible factors that appear at the beginning of a recession. Many or all of these different factors may be at work in any recession. Financial factors contributed to the economy going into recession during the 2008 US financial crisis. The overexpansion of credit and debt to risky loans and marginal borrowers can lead to huge accumulation of risk in the financial sector. The expansion of the supply of money and credit in the economy by the Federal Reserve and the banking sector could take this process to extremes and stimulate risky asset price bubbles. Interest rates artificially suppressed during the boom preceding the recession can destroy the structure of the relationship between businesses and consumers. This happens by making interest rate sensitive business, investment, and consumption decisions, such as buying a bigger house or risky long-term business development decisions, look far more attractive than they should be. The fact that these decisions do not reflect reality when interest rates rise is a major factor in large number of business bankruptcies that represent recessions. Psychological factors of a recession. Economists often cite psychological factors that contribute to recessions. Excessive investor exuberance during boom times brings the economy to a peak. On the contrary, pessimism, at least after a market crash, increases the impact of real economic and financial factors as markets fluctuate. In addition, since all economic actions and decisions are always taken with some degree of foresight, the emergence or expansion of recessions is often linked to the subjective expectation of investors, businesses, and consumers. Let's look at the economic factors of a recession. In addition to financial accounts and investor sentiment, real changes in economic fundamentals also contribute significantly to recessions. Some economists attribute recessions solely to fundamental economic shocks, such as supply chain disruptions that hurt a wide range of businesses. Shocks in key industries such as energy and transportation have such far-reaching consequences that many companies across the economy are simultaneously reducing or canceling their investment and labor plans, with ripple effects on workers, consumers, and stock markets. There are economic factors that can also be tied back to financial markets. Market interest rates reflect the cost of financial liquidity to firms and the time preferences for current and future consumptions to consumers, savers, and investors. Moreover, when central banks artificially suppress interest rates during pre-crisis boom, financial markets and the decisions of firms and consumers are distorted. All these factors can eventually lead to a recession. Meanwhile, the preferences of consumers, savers, and investors impose limits on how long an artificially stimulated boom can continue. This manifests as economic constraints to continued growth, such as labor shortages in the labor market, supply chain bottlenecks, and rising commodity prices, aka inflation. In addition, when resources are no longer available to support a company's investment plans, rising production costs can lead to a series of company bankruptcies. Such a situation may be enough to send the economy into a recession. That's it for this video, guys. Hope you guys enjoyed the video. If you do want to see more of this content, please like, comment, subscribe, and even turn on the bell notification icon. See you all in the next video.